Well, this is a great treat. I'll tell you what I'm going to talk about. As you can see, finance, science, innovation, and long-term investing. After all, that's what this whole thing is about. But we are here in the Royal Society of London. And as you heard from Jim, this is where modern science system is. So I have to say a word about science, finance science. And finance science, as a science, everything I'm saying here it is not scientific, it's my judgment or my belief. I think finance is a science for sure, but I think it was not a science until the 1950s. Before that, it had no real data, so how can you have a science if you can't really test anything? And two, if you looked at what the only controversy was whether you should use present value or internal rate of return. Now, if you look at it from today, that's an afternoon's discussion to settle. I mean, because the only way you can test the internal rate of return if you haven't done it is to first compute the present value to see if it's giving you the right answer. So that tells you what the answer is. But it was just a bunch of accounting again. But I labeled the beginning in the 1950s, and if I had to pick one piece of work, it was Harry Markowitz's portfolio in 1952. That was the beginning. So you had an organized model, definition of risk, something was quantified, there was a theory there, and it was put together. Second, I'm not going to go through the whole list, don't worry, but you could fill it out. Second, I would say, in time was Ken Arrow's 1953 paper on the role of securities. And you could go through Modigliani Miller, Tobin's addition to Markowitz, all the way through the 50s, and then you could go into the 60s. And of course, on the data side was the incredible CRISP data that was put together, every stock price from 1926 to the 60s. Okay, never been done before. And the first thing, and I won't go through all of that, was, I don't know if anybody, well, there's nobody here probably could remember it. Most of you weren't even born then. But the point is that the first thing they did, which is not surprising, they had all this data on all these stocks. So they just asked and answered the question with the data. If I took an average stock or a random stock, how much would I have earned through the Roaring 20s, Depression, the whole World War II, the whole 9 yards? And I remember it was 9.3%. Now, if I'm wrong by 0.1%, it doesn't change the story. You say, okay, that was a shocker from the data. That was more than any trust department or professional money management through that period remotely anybody knew. Now, I don't mean they didn't have all the data. So this was where it really became a science. Of course, then we had that it was a little unfair to compare a random stock to the trust departments because there was a risk difference. Along came the CAPM and said, how do you distinguish risk? And if it's a lower risk, you shouldn't expect it to do as good as an average stock. You see what I'm saying? And so forth. So by the end of the 60s, we had all of this, it was a science. It was organized, it was a set of principles, theories, and serious data. Okay? So that's science. Now, since that time, and as mentioned here, Jim mentioned it, the Royal Society hasn't been too friendly, no disrespect, to the social sciences or anything in terms of having things done here, but they did allow finance to come to do a whole day. I mean, it wasn't just that they published a paper, they published a whole day here. So that, I think, is one certification. The other is, look at the number of economics Nobel Prizes that at least part, if not the whole thing, cited finance work. It's pretty high. So I don't think we have to argue whether it's a science or not. It fits it, it looks like it, and it does it. And so that was what I wanted to say. But the transition to what I want to talk about tonight is that one of the things that happened in the 1970s was that the highest level research, highest meaning the most sophisticated research in theory and empirical work, became inexorably linked with mainstream finance practice. Prior to that, some firms had some quants. You know what they did with them? They put them in a room. And when they brought clients in, they said, here's the Picasso. They opened the door. There are quants. Close the door. Okay? They felt a little alone. That's where the Q group came from, if you know what the Q group is, which is very establishment. But there was a bunch of people getting together who felt a little left out, if you know what I mean, in their profession. So, but what happened in the 70s was there was an enormous set of shocks that came to the system. The oil shock, Bretton Woods, 10% inflation in the United States, 10% interest rates in the United States, 9% unemployment with 10% inflation. How would you like that in the 208 if you were a central banker? what do you do? Okay? So there were a lot of that, but the effect was very different from 208. 208, as you surely will say, was a reaction, let's contrast innovation, slow it down, to do it, we don't need it, it's bad, it can't help us. In the 1970s, the reaction was just the opposite. You had an acceleration that I don't think has ever been quite done, that started in the 70s, went well into the 80s, in which you had enormous innovations that are still affecting our societies today, like the national mortgage market, like all the options and futures markets that we take for granted. Like somebody was talking about institutions. Until May Day of 75, institutions paid the same commission per share as you would. So if you bought 100,000 shares, you paid 1,000 times the commission that if I bought 100 shares. It was a monopoly. It was like, you know, and they got rid of that, and I think that opened the door to the institutionalization. So I won't go on. The ERISA, the first index funds, national mortgage market, all of these things were, and that happened in the United States. What I would point out to you, just to finish it, what happened after that? Virtually certainly every developed country, but virtually even sort of emerging markets, created the same markets. They have futures markets, they have options markets, etc. We may have made a mistake putting all these derivative markets in during duress in the crisis, but you can't explain why every country has adopted them when they weren't under any duress, unless you think they're all crazy, which is possible. But I think that my sweat is that this forever, or at least up till this moment, created a bond between finance science, not people trained in finance, I mean the science itself, the models, the things that you produce, and mainstream practice. You know, the option model came out with exactly the same time the option market was created. There was absolutely no experience in trading options anywhere, because they never were traded at anything except at the money. So they had no choice. It was need. Had it not happened, I believe that's the source of where this has happened, and it's been going on ever since. And of course, it's exemplified by this wonderful event for which the NBER, bringing all of you scientists in, and all of you from Norges Bank, who are the largest sovereign, you're managing the largest sovereign wealth fund in the world, and you're here not just because you're being nice to academics, because there has been this unusually tight relationship between academic research, high level and so forth, and use. And I couldn't resist pointing that out to you all, because you're part of this, and I want you to know it. So with that as thing, I'm going to get to what I'm going to do. I'm watching the clock, Jim, don't worry, or you should worry, but what was I going to do tonight? So I decided...
We have a long horizon, Bob.
Yeah. No, I decided that I was going to try to do something in the exemplifying this tradition I just described between practice and research and science. Real science, not, sort of kind of right on the edge of doing practical work for people as your after hours. But your science that you do, cutting edge things, looking at problems, bringing your full creativities to it. And I wanted to do that. So I'm going to talk about this evening what I would call middle range approach, which is not the most sophisticated empirical science, and certainly not, I'm not going to tell practitioners how to do practice, because they actually do it. And, it's true that a plumber probably knows more about electricity than a random person, but if you need an electrician, get an electrician, not a plumber. So I know a little bit about practical world. I've been in it, but they do it all the time. So I'm not going to try to replicate that. So I'm going to be somewhere in between. I'm going to try to show you things I hope that you may have thought about before, and if you haven't, then to do it, and exemplify this. But before I do that, I always have a footnote or thing. I have a couple of things. First, I wanted to talk about, in the spirit of this mid-range, you all know my papers, or at least you may not have to read them, but you know them. They exist. So you know that I know how to do it, right? I'm talking about what I think about if I'm thinking of an institution, a big institution that has to organize itself to run, not three guys in a hedge fund or something, but a large institution. And my way of thinking about it, which is not exactly wrong with theory, but it's not 100% rigorous all the time, is what you do is you create the optimal combination of risky assets. And I mean by that literally the definition of the highest Sharpe ratio portfolio. You know, the thing that you do in mean variance or the thing you do in the CAPM. So you create that portfolio, okay? Now this is the different ways you can do that. And if you have no information, I mean, if you have no special knowledge, what do? The CAPM says, hold the world portfolio. That's not the same as an index portfolio because we can't trade everything. So it's a little more clever, but I call that the well-diversified portfolio. By the way, I say that especially because I know Steve Ross spoke last year, and we all lost a very important person to us as well as people that we really cared about, and a good guy. And Steve's arbitrage theory in that sense said, look, when you get down to it, we all know you want, you know, the CAPM is kind of saying, hold the best diversified portfolio that you have until we go to Venus. That's the world portfolio. But of course, since there's so many things missing, you know, any one index, MSCI, S&P, doesn't matter. You should realize those indices are not the best estimate. Indices have a role. It was touched on this afternoon. They need it for benchmarks. And by their nature, to be a benchmark, they have to be specified precisely as their weighting. That doesn't mean they're the best one. So tracking error to an index doesn't mean you somehow are losing. It's important to measure performance, but not important economically. I want to be clear on that. I think Steve's was a much better idea. You know, if you held 12 or 14,000 different stocks and you collected them reasonably, that's a well-diversified portfolio, you know, from around the world. Whether they have the market weights, I'd be more impressed with that than a 200 stock portfolio that's value weighted. I'm just telling you that as my view of how to read the theory. That's what we're building here. And then if you can add alpha to that, and I'm very precise what I mean by alpha, because you know alpha gets used for everything. You know, you have 16 factors in alpha. I mean literally the original alpha. Alpha exists means I can create the optimal combination of risky assets, which is the highest Sharpe ratio portfolio. I can produce something better than the market portfolio. That's all it's telling us, okay? So I'm not going to go into alpha now, but you all understand. This is, by the way, there's 3 ways to manage risk. I'm telling you this, you know it, but I'm reminding you. Diversification, hedging, and insurance. If you got a 4th one, tell me. Luck doesn't count. I don't know how to produce that reliably. So if you do that, here is where the diversification comes in. If you had no information, that's what you're doing, holding the best diversified portfolio. Where does hedging come in? Hedging, which is different from insuring, is where you give the upside and the downside both up, right? That's, okay? That's when you mix with a risk-free asset. This is standard portfolio. That gives you some kind of optimal. Now, we have a couple of more steps, which is what I want to get to here. We know in a more expanded theory that there are other variables which could be priced, that is to say, other risk variables that are not diversifiable that matter to people. Same idea as the market portfolio, but in other dimensions. So interest rate risk, Sharpe ratio risk. Are you going to be in an environment with high Sharpe ratios and high interest rates, or flat Sharpe ratios and low interest rates? That's a risk every investor has. It's a risk you can't diversify. It's always been there. It always will be. Does that sound like a risk that you're familiar with? That's the story you say why there's a market risk premium. Will the risk premium always be the same? No, and it's not the same always for the market. Which we know there's one there. That's a fast path. So we know we have hedging. And then where does the insurance come in? That's when we modify the portfolio. So we now have the most efficient portfolio, you know, in terms of we're getting the most bang for our dollar. And then we've maybe adjusted it for exposures to other things. But now, depending on your objective function, you would say preferences, that's when insuring comes in. So say you want a floor, you have to have an absolute minimum. But then the upside, what's that shape? It's nonlinear. You can't get that from a simple portfolio. That's a put option or a protected put. That's insurance. That's nonlinear. That's different from hedging, and it's different from diversification. And that will be determined, you would say preferences. Now here's where I move to the middle range. I won't ask you, but you don't really know the preferences of all the current and future generations of Norway who you are responsible for looking after or helping out. And even if you did, even with big data, that's a lot of computing. And where would you get their utility function? So what I think happens is, at least for the moment, is that at the other hand, you don't throw up your hands and say, look, we'll just do some rule of thumb. I think you can say you establish goals. Let me give you the fastest example, that's big and long-term investor. Pension funds. A pension fund is set up to do what? Meet the liabilities that have been committed to. All right? What is the goal of the pension fund? Its goal would be to pay 100% of the liabilities. If it did that, it's done its job. This is not somebody's personal portfolio. We're talking about why do I have this portfolio? Because I have this portfolio to try to get rid of the liabilities. My goal is to do 100%, not 110%, not 120%. Would I want more money? Sure. If you give me everything I want that I'm supposed to looking for, plus a boat, even if I don't have a boat, I would give it away or sell it if I get it for free. But it never comes for free. So I'm trying to remind you that even if you don't know the preferences, you tend to set goals. The best goals that we know, and this is how DB plans are run, they have a goal of trying to get 100%. They may say 80, but that just changes the level, okay? And they may have a floor. You know, we want to try to get 100% funding, but we can't get less than 50. That's a typical way of describing the goal. A goal is 100, but you have a constraint. Do you understand what I mean by a goal? I could have another goal, which is to pay my taxes in 90 days. All right? Do you understand what I mean by a goal? The goals are implemented by bringing in what we call nonlinear derivatives options. Now, if you're not allowed to trade options, or they aren't options traded on your portfolio, what do we know from finance science and experience? There's a replication formula that says there's always a dynamic strategy to match every derivative, and you can run it either way. You can use a derivative to match a dynamic strategy if you're trying to minimize a transaction tax, or if you can't buy the derivative, you can do the dynamic replication, you know, with error and so forth, but you can do it. So this is just another way to say there are going to be dynamic mixes of those two instruments. But if you go back to the basic finance, I'm doing continuous time here, let me do it, you know, you got to pick a time interval, sorry, I picked continuous time. What do we know? We know from the ICPM type thing that you always want, as one of your portfolios, a mean variance efficient portfolio, or call it the growth optimum portfolio. It's the same thing, all right, in continuous time. It's just different scaling. It's the same mix, all right? But then you mix hedging things with it, right? So you're always going to want this portfolio, but you mix it to deal with all these other instruments. So you can replicate the goals, all right? So everybody understand that's the process. Now, what's the next thing I want to say? Goal-based investing is a way of improving performance. I'm just going to demonstrate fast because I got a lot to do with you tonight. When you want to get out of here, I know. So let's just say I have a goal. Would you mind? You're my client, okay? And he's my competitor. He's darn good. In fact, I can't get a Sharpe ratio better than his. So normally, right, everybody shows you, where they show you out, I can help you get a better Sharpe ratio. That's what you pay for mostly, right? Most outside managers and so on. I know you have other things, but that's what a lot of money is paid for, right? I can't argue that, but I want you to hire me. So how do I do it? He's got as good a Sharpe ratio. You've told us that, you know, you want the best portfolio, best risk return, but you've got a floor. You've got to, don't, you know, if you don't like the number of zeros, you can put 9 or 12 zeros after this so it gets your attention. All right? So we have a payoff. You've told us, both of us, we have to have a 95 minimum. So we have to deliver that. You see, we have to have a put. It's the only way we can get that picture. So both of us have got to pay for a put with your money. And he thinks he's actually got a little better Sharpe ratio, so he thinks you're going to hire him. He goes home. I stay with you, and I say, let's talk some more. And I say, tell me about what you really want to do with this portfolio. And I tease out of you. So I'm actually talking to you. I'm not talking about the weather. You tell me, actually, if I could get to 190, I'm done. That's my goal. Think of that again in the sense of a pension. 100% is financed. Now, you would like more, but your purpose of this portfolio is you want to get to 190. It's like if you hire your travel agent to fly you to San Francisco, If they also give you a free ticket to go to Dallas afterward, if it was free, you would take it, but you really want to get to San Francisco, and if you get there cheapest, fastest, and most comfortable, you're happy. Do you understand? So you say that to me. Now I say to you, hire me. I'm going to do better than he does. And by the way, you don't need to bring your quants in. You don't need to do any simulations. Let me tell you what I'm going to do. Instead of what he and I are doing, this is what he does. He gets you to the floor and gives you the upside. Sharp ratio, you know, the best Sharp ratio, it's all there. But of course, he has to pay for the insurance. That's hedging and diversification are free, but insurance you pay for. So he can't give you the 45-degree line. He gives you this place one because he has to use, like I do, some of the money to pay for the put, the insurance. So instead of investing 100, he's going to invest 95 for the Sharp ratio and buy the insurance for 5. Well, I have to buy the insurance too, and let's just say we had the same Sharp ratio, in fact, the same portfolio underneath. So I have the floor, but what I do is I sell off a call with a strike price equal to 190. Do you understand? I just sold a call. I get paid for that. That's insurance. How much? I made them the same price. This picture would be easy for you. So I get $5 per 100 for a call, which allows me to pay for the put. Just if they're different prices, you get a different picture. But, okay? You see, I took in more money. Why? I gave up your upside. But what did I get you? I put you on the 45-degree line. Now let me summarize this. You can tell this from this picture. And you don't even have to know the probability distribution. So that's why we don't have to do any simulation. Let's look at all the outcomes that matter to you. Right? I say this portfolio has a higher probability of getting to the goal than his. And you know what? If we don't get to the goal, for every outcome, I'll have a smaller shortfall than he does. Does that sound like better performance? In the whole range you care about, you told me, I didn't tell you. In every state, you're better off with me than him. That's a pretty good sales thing, and I didn't need one simulation. Now, I know I'm simplifying, but what does this tell you? I took the trouble to find out what her goal was. That was the real work. And I said, if you agree to that goal, if that's what you really want, I can outperform him. Not because I have a better Sharp ratio, and I'm not faster, quicker, smarter. What I am is, I tailored it to what you need, and what I did is get rid of payoffs that weren't important to you to enhance the chances of getting what is important to you. That's like preference function, but I'm using goals because I think that's the way the real world describes these things, because it's too complex. Think of goals as a simplification of having a whole preference phase. That's why goal-based investing can improve performance, and I believe, by the way, with all the composition for Sharp ratios, I won't ask you to opine, but when you get down to 2 finalists, pretty hard to tell which one has the better Sharp ratio, I'll bet. I'm guessing. Because if you make it to the finals, it's like, you know, who's going to win the 100-yard dash in the Olympics? What's the difference between the first and third guy? It's hundredths of a second. Difference, but pretty tough. Okay? So that's goals-based. Now, next thing I want to do, because I got to watch the time, I know. Okay? What I want to say is, the next thing is, this is for you. This is all about long-term. I have 3 things I want to talk about long-term investors, but I wanted to point out one thing before I get to the 3 things. You know, 3 is always a good number. 2 is boring, and 1 is too singular. So now, this is a case of a pension fund, or importantly, a DC, your individual DC account, which I may be managing for you. In fact, under QDIA, in other words, if you're in a default, you don't know what you want me to do. You won't even tell me your goals. I have to make the goal up for you. But what do? What's a good goal for you? I don't even know you, right? How about that a good retirement would be being able to live the way that you become accustomed to living in the latter part of your work life and live that way for the rest of your life. Not too bad. I mean, of course you'd like more, but I can promise you, you're a young group, but when you get there, you're not going to want less. Unless you're not well, and then you need a lot more money. Okay? So if you accept that, I can set a goal for you, right? And this is what DB plans have kind of done. They kind of ask with Social Security and this, if you live off, this is for working middle class people, you know, and so don't do introspection. You're not working middle class. because you're in finance, which is wonderful, but don't do introspection when you're building these systems or making judgments. So what we do is we list the balance sheet of all the retirement dedicated assets, and then the retirement liability, if it were a pension fund of a corporation, is a real liability. But if it's your DC plan, it's still a liability to yourself. Just because we go from DB to DC doesn't mean your preferences change. Everybody seems to like DB plans, right? Do you know of any employers who have marched on their employer to get rid of the DB plan and replace it? I know of no one in the world. You give me an example, that'll be, as Paul Samuelson used to say, the exception that improves the rule. But the point is, so your taste don't change. So this doesn't matter whether it's DB or DC. What's happening is you want to look at the assets that are committed, only that, because this is only about retirement, not your whole. And what are your liabilities? You may have a minimum, and you're trying to get to a desired, that goal of a good retirement. All right? Now, why do I put this up there? By doing it as a risk balance sheet, it's not just the magnitude of these numbers, it's their risk characteristics. If I'm trying to match your standard of living that you enjoyed in the latter part of your work life, this is very low risk, future contributions. Even though your wages may be uncertain, because it's relative value, it's Modigliani life cycle. If your wages go down, that's the bad news, your standard of living goes down, but so does the amount that you want to retire at. You don't keep the retirement at the same level, you balance it. If you're doing this for many generations, you're balancing the generations, right? You're not saying we're going to make the third or fourth generation from now in Norway, we have a target for them no matter what else is happening. But I thought the idea was to try to balance, conceptually balance the many generations. So the concept's the same. And if you have that, then actually future contributions, you can have disability or something, but it's actually pretty low risk. Why I say that, without knowing the goal, you can't possibly even know what's risky. And that's pretty dangerous. So quickly, for long-term investing like pensions, what's the next one? Sovereign wealth fund. Okay? Well, I suggest the balance sheet you look at is the government. And I include the central bank with all respect, because, when our Fed buys from the Treasury and back and forth, if you look at it as the government, there's reason to keep it separate, but you are not for this. What we do is put all the assets of the government, and they're very different for different countries. Some have very big government-owned enterprises. Actually, some pretty big ones. In different parts of the world, that's big. In Singapore, they don't have too much oil that I'm aware of. They have a lovely harbor. But, and that is part of the balance sheet. Here's the wealth fund, and then maybe you have a specialized pension fund which has its own goal. Over here, you have all the liabilities in order of what I would think is, there are things that you would default on your debt before you would do, like national security. So that's all that's there. We got the base. You see I put everything in there. Foreign currency debt, pension liabilities, and then all the guarantees we've written as a government. And then we have what's left. What is that? That's basically the total value of what the government has for society that is not committed. And you can put multi-generational liabilities up there as part of those other items. Say we want to make sure that the next 20 generations, or as a perpetuity, we're going to pay that. You understand? So in some ways, I'm thinking of your bank, the Norges bank, and I'm thinking of a pension fund, because they're two very long-term investors, and I think they're interesting because yours is closer to a perpetuity, because I think, as I understand your goal, and whereas if I have a pension fund, personal or not, it's very life cycle-y. In other words, I keep getting closer to when I'm going to cash in, and so it has the life cycle effect, whereas if it's a perpetuity, you don't. We all know that, right? So I thought I'd choose those. And by looking at these risks, you can first decide what should the sovereign wealth fund do. Now, you've got debt management going on here. You've got currency reserves. You don't want to centralize that. You let them all do whatever they want. But somewhere in that balance sheet, there has to be something that thinks about the risk of this, because that's what matters, right? And so if you're doing a bunch of other things, somebody has to say, wait a minute, we're taking too much risk for the whole government for the long term, and maybe we do it. And that's how you can figure out maybe what the sovereign wealth funds. The easiest example of sovereign wealth fund is if you have a big amount of oil on that balance sheet, you're probably not loading up with the market weight in oil, I'm guessing. You don't have to tell me, but I know it's on the computer. You make everything public. So I'm not talking out of school here. Well, that sounds trivial, but think about that. So you're not going to be impressed if someone says, we have 4 models. Here are our 4 sovereign wealth models. If you are of this size and this shape, we put you in this bucket. You wouldn't put up with that. What you want to do is go through all of this, figure out the strategy, and then optimize. Remember where the optimization is coming from? It's dynamic mixing to optimize the goal, making that optimal combination of risky assets, right? So we're all okay? Now, let me quickly move forward. Oh, one more, this long term, since many of us are from universities, and if you were taking Harvard or MIT, I'm being very provincial, you know that gifts and so forth are an important part of the portfolio. And I always say, if MIT didn't have $1 of its endowment in tech, it's got a big tech investment. I mean, come on. What do you think? Or the Harvard Business School. I mean, you know, if you don't take account of that. By the way, if you're interested, someone did a back of the envelope, and I'm pointing to him because I know he's at Harvard Business School. I know there are others. The beta is 0.6 on giving to the S&P. Do you think you have a little exposure? And try it on your publishing, which is trade books, very sensitive. Executive education. HBS is loaded with big beta, okay? Which is good when the market goes...
And operating leverage.
Yes, and operating leverage. Okay, so I'm not going to go through these. I showed you is the risk balance sheet is one way to simplify your lives. Because if you just do it without that, and you put the sovereign wealth fund, the thing you're managing is the only thing, then you got all these extra hedging terms. Because you're going to say, but they really have oil, so we ought to do a term for that. It gets very disappointing. Here is a unified way of doing it. You list everything. You may not be able to value it perfectly. You will be going fine. Do you understand? And then you can use a simpler model, a more general model, a more standard model to do the optimization once you've taken account all the assets. All right. Now, of the 3 things I'm going to say in my last minutes, I'm going to talk about the risk-free asset. This is going to be a boring talk. It may be already, but it's going to get more boring. What's the 2 things that nobody ever wants to talk about when you're talking with professional investors, money managers, and probably most academics working here? The risk-free asset gets about 10 seconds discussion. Boring. The second most boring is diversification. I mean global diversification. I mean, the passive part. Boy, they're boring. But I'm going to say how we can improve performance, I think, with a few things we can do there. All right? And then there's one more. So now let's talk about the risk-free asset. In my own thing, when I first did the intertemporal model, I said, what's a risk-free asset? Well, I decided to define it technically. It was the asset that was, for sure, you could over the shortest feasible trading interval. So if trading took place once a day, it's a 1-day bill. If it takes place continuously, it's something that's T plus DT. You understand? But it was defined technically in the sense, it just said, by definition, it's the asset whose return over the shortest trading interval. That's much shorter than the horizon of Norges Bank. Okay, do you see why it's technical? Because it's just now what's nice about it, it's unambiguous. And I wrote my papers and derived the demand functions and the equilibrium with that. And we got all these factors and other things that came out in the more complex case. But everybody knew what the risk-free asset was, okay? I describe here what I would call, I don't know, maybe someone has a better name or maybe someone already defined it, the Numerator risk-free asset. Now what's that? That's the risk-free asset. It's the lowest cost asset, so there's nothing left in it, that would pay off all the payments in your goal. Remember your goal, the 190? It pays all your payments, so if you have many payments, it's a whole stream. All the payments in your goal for sure. Okay? So that's defined. Look at your goal, look at all the payments, and put it in as for sure. That's what I would call the Numerator risk-free asset for you, okay? Now, it has the feature that if it's actually an asset, it will turn out that if you use that Numerator, when you do your optimization of the goal, this asset in the Numerator has a 0 return and 0 risk. Suppose your goal was shares of Microsoft, not price of Microsoft, shares. Then if we measure your Numerator shares of Microsoft, what's the change in the share of 1 share of Microsoft for 1 share? It's 1 for 1. So it has 0 return and 0 sigma. You all know that. If you have a numerator, which you can express as an asset price, it has 0 interest rates and it has 0 return. Now that's nice because now the risk-free rate is always in your actual calculations, a constant 0. And it doesn't matter how complex the payout is in terms of this thing because you've defined the risk-free assets. You don't have to make any approximation on that side. So that's a good thing to use. And in fact, it's really a good thing to use, like in a pension fund. You know what the risk-free asset is going to look like. It's some long-dated bonds with no payments if it's for one person or a stream of payments out to the goal, and that's it. So what is the risk-free numerator asset? Is it a treasury bill? No. It's a long-dated bond. So the first thing you see is a numerator risk-free asset. I'm just stop calling it numerator. The risk-free asset depends on the goal. So if you think you're not a goal-based investor, whatever you use as a risk-free asset is de facto your goal. So if you use a 90-day treasury bill, your goal is 90 days, unless you use it technically. So that's one reason to be interested in the risk-free asset. And it's well-defined whether it exists or not. So I may go to the marketplace and there is no risk-free asset traded. That doesn't mean it's not well-defined. It's just I can't buy it. Okay, I'll deal with that. Next thing is, and that's where I say, if it's not available, we create a surrogate risk-free asset. And I define that for you before we leave, I hope. Okay, I'm getting 10 minutes, yep. So it's going to be a fast one, but that's okay. I've done it. You're a smart group. You're better than my students. Much better. And they're good, as you know, because many of you are teaching the same ones. So I can do this. So the point here is, let me just finish it. The risk-free asset is dependent on the goal. And so every one of you, your numerator risk-free asset in this room is different. If it was retirement, if you're retiring on a different day or you're a different gender, you have a different risk-free asset. Why? Because your life expectancy depends on your gender, for example. Okay? So there's zillions of risk-free assets out there, but they're all well-defined, and they're relevant to use with your goal because they have this nice feature that you know exactly what the risk-free asset is, and you get all that cleaned out. You don't have to do all that adjusting that my model did, that I used the wrong risk-free asset, because your horizon is nothing like the shortest trading interval. So you see what it does? It simplifies it. Now you know what's risk-free. Why is that important? What's risk? Risk is equivalent to nonlinear. It's only defined as a complement to a well-defined set. The risk-free asset's well-defined. Risky is everything that's not risk-free. You know, linear is well-defined, nonlinear is everything that's not. There's no general theory of nonlinear equations, and there's no general risky asset. Risky asset is only defined by the risk-free asset. That's why it's important. Even if you don't invest in it, you got to know what's risky. And let me just jump ahead because of this. So to a couple of pictures that some have seen in a different context. I took here a typical 45-year-old who's going to retire at 65 and asked, what is his risk-free or her risk-free asset? Well, I'm not talking about buying the annuity. What I do is I do a traded portfolio. This happens to be in TIPS, so it's inflation protected. I do a dynamics trading in this has been done for 30 years, so this is pretty standard. Do dynamic trading in TIPS to replicate the risk of the annuity, because we don't want to buy the annuity, because you don't want to give all your money away if something happens to you when you're 42. So what we want is hedge the price you pay for the annuity. So I'll hedge that, which has nothing to do with your individual health or anything, only your age characteristics, because what the insurance company will pay for it. But then when you retire, you actually get the annuity, because now you care how long you live rather than how long the average lives. Understand? So this is a hedge portfolio actually run from 2003 to April 2012. Those are the monthly returns measured by NAV. Does that look like a risk-free asset to any of you? I doubt it. It's as volatile almost as the stock market. That's the monthly returns. What's the problem? I showed you the returns in the wrong metric, the wrong numerator. This is dollars. That's like your risk-free asset was a overnight treasury bill or a monthly treasury bill. So of course it looks terrible. When I measure it in the right units, income units, starting in 20 years, which is your risk-free asset, of course, if I did it perfectly, you get 0, 0, no risk. Do those look approximately the same? How many people, when you look at the real world investing, either for DC or even for DB, but especially DC, how many people realize that as part of regulation, Department of Labor and SEC, we have to send the NAV to all the DC participants. This is what they see, and this is what they learn as risk for them. Now, here's the flip side. What's the gold standard for principal? Treasury bill. This is 90 days Treasury bills, real returns over this period. No vol, low return, just exactly what. This is what happens if you put Treasury bill in a retirement account and you look at it in the thing that's there. It's one of the riskiest assets on the planet. I don't need to show you that since we've seen short rates go from 4 or 5% CDs 12 years ago to 10 basis points. That's a 50-fold decline. Huge vol. Why is that important? Because regulation makes me send that to every member. I'm teaching every member that risk that matters is the NAV. And I'll tell you what the perverse thing of this is because of the shortness of time. Because of that, you have these things called target date funds, which are allowed not to be sued. They're a recommendation for DC plans. They have one feature. They put you more and more in fixed income as you get older. That's a requirement. It's supposed to make you safer. Now here's what actually happens in the real world because of this one way of looking and measuring the wrong way. What happens is, I have a 62-year-old who they've made it, so I put him 100% hedged. This, if interest rates back up 100 basis points, he's going to see, or she's going to see 15% decline. At 62, they're going to be on the phone to the HR department saying, what is going on? You've lost 15% of my retirement income. I want to find out who did this. I'm going to sue you and then shoot you. Sue first, shoot second. And then they get all their friends, because since it's the interest rate, everybody's got the same impact. So you put them in the safest asset. The phone's ringing off the hook at the HR department. They call you and say, what are you doing? I don't want to have our employee. So you know what they ended up doing? Go and look at the data. They put them in 3-year notes. Why? Because now you don't get the volatility in the NAV. You get this. See, you get this versus that. So I'm trying to show you these are not trivial effects. This is not just measurement error. By choosing the wrong risk-free asset and writing regulations of what risk is because you've measured it wrong, you're actually making everybody systematically, because these are QDIA. These are 90-something% of, I believe, the DC money of this kind goes into these things because they're QDIA. Okay? You're taking whole generations of people and you're putting them in riskier and riskier positions. You want to see how risky? Take a look at the difference. This is the standard risk return points. Treasury bills, this crummy, high vol, low return asset that you saw there, and there's equities. Here's what it is when you measure it in terms of the relevant risk-free asset. It's as though T-bills have as much vol almost as the stock market, and they have negative returns to boot. That's about as bad an asset as you can buy. Now, I know this isn't high science. I'm trying to show you that these things that we're talking about, measuring it wrong, the risk-free asset wrong, isn't just measurement error. It leads, and when we make it law, I can't even not show this to you. So you know how people learn. They learn by doing. All right. Well, surrogate risk-free asset, all I mentioned there because of the time is, don't let anyone tell you because there isn't an actual risk-free asset out there perfectly to hedge, that therefore might as well hold timber or stocks or something else. The right risk-free asset is you create a surrogate risk-free asset. What's that? That's the asset that comes close to tracking the true risk-free asset if it were there. Minimum tracking error. Okay, that's your criterion. And that's your surrogate. I guarantee you that it will not be timber, and it won't be stocks, and it won't be commodities. It'll probably be things like tips in different countries, but other things like that. It's not going to be those with very high probability. But whatever it is, you have a rule here. First, you find the portfolio that has the least tracking error to what you want. Secondly, because it has tracking error, there it is. You have to put a reserve on it because you want to treat it as a risk-free asset. When you had hedge, you can't do anything more. All you can do is put a reserve up. So what you do is, if I've got tracking error, it looks like that curve, instead of pricing the asset at the market, I price it at enough reserve so there's a 98% chance I'll be able to pay. That means I have to create a reserve. That means if I'm pricing the risk-free asset, if I have a 10% reserve, then I divide the price by 1.1 because you convert it. The beauty of this is it's automatic. When you have low tracking error, you have a low reserve, you understand, then you get credit for better tracking. If you have, so for a 62-year-old, we can hedge that very well. For a 28-year-old, but that's what you want. So don't let people do that. Well, I know I've run out of time. Sorry about that, Jim. I had 2 more, but all right. You can all leave, though. I mean, except the bus probably won't leave without me. All right. So let me tell you another one, because this is real world today, right now. Okay? I mean, that other is too. I mean, this is happening in the DC system. I mean, this is really happening. This is a situation about diversification, the second most boring after the risk-free asset. And we're going to talk about China here. And as you're well aware, China has always had some degree of capital controls. It's not free. Chinese nationals can't buy assets out of the country. There's allocations. And after the 2015 decline in the market, after a big rise, okay, they responded by a lot of things because, as they say, stability is more important than growth. And they felt they were just worried, so they shut down their futures markets. They put all kinds of restrictions on, and largely got into capital controls, more than they even were before. Okay? Now, I'm not to talk to you about capital controls. That's outside my pay grade. Okay? But what do capital controls do in finance? Well, I want to show you a fast picture here that people can understand who are not finance experts, but are people making decisions on policy at the highest levels, because this is. First, you want to show what is the cost of capital controls from a finance point of view. Leave aside anything else. And what I did is we know that the world portfolios, at least theoretically, I did this with MSCI World. Don't take the numbers literally because I'm illustrating a process. That's what my sister holds. My sister's very smart, very talented. She doesn't know anything about finance, so she just holds a passive portfolio. So that's the ex-post risk return of my sister's portfolio, who knows nothing about finance. Here's the return you would have gotten if you invested in China ex-post that period. You see the Sharpe ratio is a bit lower. Now, it's not fair to compare those two because, random draw. This is after the fact, right? So what I did is a simple thing. I created an ex-ante estimate conditional on what happened to the world, which is essentially if China had been zero beta, neither overperformed or underperformed, what would you have forecast? That's this line. That's close to. It's not the most optimal, but it's easy to understand. That is the cost of not diversifying, but just holding China. Now, I'm so glad you let me do this because I have a vested interest in the next slide. I'm looking at the two of you, okay? So you see, first of all, this establishes a problem, right? I mean, I'll tell you don't know where you are on the frontier. If you did a rough estimate with these numbers for China, all the things, it probably cost China 300 basis points a year. Now, the rule of 72, 300 basis points doubles your money in 24 years, which is about one generation or a little less. So the way you might frame it to the people is to the cost. Not saying you shouldn't do it. You would have twice as much money in your pension fund in one generation if you didn't have this drag. That's a big number for 1.3 billion people. So that gets attention that this is not a small cost, which a lot of times people think, it's a few basis points or something. So that's the first thing. But if you just show people a problem and say, you've got a problem and leave the room, I always tell my students, that's a bad strategy with your boss. First, your boss probably knows that the problem is there, and you seem to be telling the boss you should fix it. So you always want to have a solution. So here's the solution from financial innovation. What we're going to do is right now, I'm assuming it's complete capital controls, and then you can adjust it for how much. All the A shares, just do with stocks. All the A shares are held in China. They have to be if you had full capital controls. And so they're all held in sovereign wealth funds, pension funds, CIC, wherever they are, even though CIC is not supposed to hold them, but they do. Okay? And so the return to those funds is the return on China A shares. Now, what if they entered into a total return swap with, and I'm going to tell you who with, okay, a total return swap where they paid the return on A shares and received world. What do they have? They still are holding all the shares. They're voting all the shares, so the governance is all in China, so you don't have to worry about that, okay? All the investment is inside China. So it meets government, investment, all those policies that you hear are reasons to have capital controls. But now you're getting world portfolio in China. Pretty cool, right? We picked up 300 basis points. But what about capital controls? Is there a problem with capital control? Answer is no. This is better than capital controls. It's not only not violate capital controls, it's better than capital controls. Why? Let me show you. Well, before that, answer the question. You all understand a total return swap, right? If they don't do the swap, they just keep everything in China. They get the lower return by 300 basis points. And what's the risk they got? It's China risk, the same thing, right? Inefficient. If they do this, we know they're getting the 300 basis points ex ante. That's good. What about for capital controls? Well, first of all, there's no money that flows. These swaps are exchange of risk on the same notional amount. There's no money. So when you buy the swap, no money goes out of the country you're in. But then you have to settle the swap. Say you settle it every 6 months or every year. Okay, first of all, you know when the money's going in or out. You know the exact date. So it's not like a big shock where people are pulling your money out. It goes out whether times are good or bad on a given date. But the most important thing is, what are the flows? When does China pay money out? That's what you're worried, right? With the capital controls, you're worried about money going out, right? Only when the Chinese stock market outperforms the world stock market. Are those tough times for China? No. That's a good time to be paying. You don't need capital controls when you are outperforming the rest of the world, or it'd be very rare. But what happens when you underperform, when times are tough? Maybe none of your fault. Money actually flows in. So it's actually more stable than the capital controls when nothing happens. So you get a higher ex-ante return, and you can make the case, common sense. This doesn't require a lot of econometrics to show them that it's actually stabilizing. So the flows are controlled because you know what date and you know what amounts, contingent, you don't know how much. But if, let's say Chinese market craters, which way does the payment go? Okay? So let me just quickly on this point out that sounds nice in theory, but the first question I got was when I showed this elsewhere, wonderful professor, where, if we took all the A shares, or a big chunk of A shares, and we did this swap, who in the heck is going to be the counterparty? We're going to have to pay through the nose to do this. What's the first thing I say? I know where your counterparties are. What do we know? The best diversified portfolio is the world portfolio. If China is overweighted in China, what's true about the rest of the world? It has to be underweighted. Means there's demand there for China. I'm not talking about information trading. I'm talking about structured risk that you hold all the time. I'm not talking about playing market timing or anything. I'm talking about core holdings, big core holdings of big long-term institutions. You're something like the market portfolio. If you can't get Chinese A shares, you would like them. So what do we say? I know where to go. I'm a teacher. I'm not a marketeer. I know where I'm going to go. I'm going to come to you and say, I bet you either have very expensive ways of getting the A shares or you don't have enough of them, especially if it was full capital controls. You wouldn't have any of them, really. So you want them. Now, the next question is, what do we do about implementation? Can Goldman Sachs do these tens of billions or hundreds of billions of market exposure swaps? And what if it's Deutsche Bank? I mean, my God, credit risk, right? And I say, you do not need Goldman Sachs. You don't need Deutsche Bank. This is a swap of traded securities. The pricing of that swap, you could get a first-year MBA to do. Or, more prudently, and I'm not going to put a plug for him, but you may know Gifford Fong from MIT. Gifford Fong, for decades, has had a firm that does risk management. He'd hire something like Gifford Fong. I'm not pushing. Say, we'll agree that Gifford Fong will compute the swap price. Very capable of doing that. And the counterparties will agree that Gifford Fong doesn't have and we pay him X dollars a month to do this, or whatever. So pricing a swap on traded securities is not rocket science. So you don't need Goldman Sachs or people get paid millions of dollars a year to figure out that. And what about the transaction? I would guess, I don't travel in I'm not at the meetings, but I could name about 30 or 40 institutions in the world, sovereign wealth funds, reserve funds, even without going into private sector at all, where you all know each other, you all know your credit, you all understand this is not a trade, you all need the risk sharing. Why do you want to waste any money on that? Why do you want to have any credit risk? Just do it with each other. And by the way, swap contracts have been used for decades, including, I would suspect, most of the sovereign funds and others have used swaps from time to time. So that contract legally has been already adjudicated. It's not like you got to wait 10 years to see if those things have been forgotten. These contracts are out there, you see. So if you go through it, now I've really run over, but if you go through it, each of these things, first of all, I showed you it was a right-way contract. That's jargon, meaning you pay when you do well and you get paid when you do poorly. And in the real-world markets, the same contract will trade at a different price if it's right way or wrong way. Meaning, if I have to pay when I'm down, which is typical if I borrow in a foreign currency, versus a debt, versus a right-way contract, the prices are different for a good reason, because the risk... So already, and half the time you owe money, which means half the time you're not even extending credit. And on top of that, you're doing it with counterparties who are the best counterparties in the world, and you've eliminated all the transaction costs. And by the way, you have a steady supply on both sides, because both of you always will have that need, all of you. And by the way, if China wants to bring some of this diversified stuff into China for distribution to people individually, like in funds, then whoever your counterparties are can then sell it, do contracts with internally. So if it's with CIC or reserves or whoever, they could do contracts. They would sell off their risk, of world. They would sell that off, let's say, to local institutions who then could distribute it if you wanted to do it. Now, I'm taking you through this nuts and bolts because what I want to see is I think is a very strong feature of innovation when it's done well. Unlike an original piece of research that has to be some clever new tool. If this is a solution that hasn't been done, and it hasn't, and you have a big solution, then you love it that you're using tools that everybody knows, that have been adjudicated, have been used in enormous scale, that the legals are there. You can point out how you can do it at virtually no transaction or credit costs. And, in both, they're also, swaps are, unlike a lot of things, are reversible. If you change your mind, you can do a swap the other way, you're out. And you don't change anything around. So I've gone on about as much as I can. There was a third one, but I'll leave that for another night. It's called Financial Service Alpha. And all that's saying is, I would say, since we mentioned corporate finance today, I want to there are parts of your portfolio, I'm looking at you because I don't see anybody in pension funds, but you particularly, okay? That's the price of coming to dinner.
So Bob, I'm going to say special dispensation. You've got 5 more minutes. Do this last thing, and we close it
Okay,
out.
so you all got it. All right. So the only thing I wanted to say was that you can do financial services. By that I mean, I believe, actually as an aside, that most hedge fund returns, and I believe this when I had a hedge fund, and I told investors at the time, so it's not a new theory of the week, that most hedge fund returns come from financial services not being faster, quicker, smarter. And we don't have to agree with me, but I'm saying a lot of the return, they're really financial institutions, meaning they provide financial services in the market, but instead of getting fees, they earn a spread like a market maker because they do it through the capital markets. So they register as an alpha. There's nothing wrong with that. I'm just saying it's a true alpha. It's just not an alpha from being faster, quicker, smarter. All right? The advantage of that is you can do it much bigger scale than information trading, because it isn't an information trade, and you have a comparative advantage. So the way you ought to think of financial alpha is more like corporate finance, because what do we know? Having an alpha is the same as having a positive net present value project. Discount the expected cash flow with the cost of capital. They're the same statement. We normally in investing talk about alpha, but in this case, I would suggest for financial alpha, you may want to think of it more like financial service. We're providing financial services. We get compensated for doing that, and we're the best ones to do it because we have the attributes. You are a sovereign wealth fund, like a hedge fund, is not regulated very heavily. You don't have capital requirements. You don't have all these other things. You don't pay taxes. You don't have liquidity demands. You're the ideal counterparty for financial services to institutions like banks, insurance companies, even pension funds who do have those rigidities. Even within your own, I'm using you because you're here, but within your own groups, you have the current life cycle generation. That's all the people who are kind of alive now, who if, they may be very little, but if they were thinking about it, they see the end for themselves. So they are thinking in terms of the, you've got this goal, you want to get there in, for you, 50 years, but when you get to retirement, that will be the thing. That's life cycle. You're not really thinking life cycle because you have all of those generations. It never ends. So what can you do that they can't? The people that are not yet born that you're worrying about can't trade themselves with the life cycle people here. So what you can do is create bonds and give her, or give me to do for her, the bonds that she needs to hedge her risk-free asset. But you're doing this all in your portfolio because you're doing it for everybody. She's in your portfolio, right? And where do you get the funding for that? You get the funding from that from the generations in the future. What do you give them in return? They're writing insurance, they're writing a risk-free asset. They're going to get the returns because she's capped. Remember that goal? So you're doing an intergenerational risk transfer, and you have a way of thinking about that that's not just doing it. So that's a financial service. And I think these numbers can be quite large, but you should think of it as a business because it's more like it's a positive net present value because you have a comparative advantage over others. And that's the way to think about it. That's my third one, and I think we'll quit on that. Oh, one other thing is we're walking out of the room. I know. I just recently sent out an innovation that we were pitching, which is called selfies. I never made up the name. Arun, my co-author, he's very good at titles. But what it is it's a bond that doesn't pay anything for some number of years, and then pays a level stream, but no balloon payment. So it's like a deferred annuity, but without the longevity. That's the perfect kind of thing when this 45-year-old's not going to retire till 65, so they don't need any payments before then. So you give them a zero. But then they want something that's a stream of payments. That's the standard of living. They don't want the balloon. But we want it not indexed to inflation, which is a good idea. We want to index it to per capita consumption. And that, if you think about it, is even probably a better hedge. Why? Because it not only hedges your inflation, it hedges standard of living. And if you're going to live a long time in retirement, would you really want to be using the televisions and the computers that you got when you retired at 65 when you're 80? Probably not. So, and if you believe in relative utility, how I feel is relative to how everybody else is, then that's another way of thinking of it. And the beauty of it is if a government does that, either with a sovereign wealth fund backing each other, or does it directly, it has the perfect hedge, a VAT. So it's easier to hedge per capita consumption than it is to hedge inflation, because you've got a big revenue source, which is by definition, if it's working, consumption. And in an economy where you don't trust the accounting, you could actually work out and take the VAT revenues, which at least are real numbers, and divide it by the tax rate. That would give you consumption, and divide by the population. So this is a really, it turns out the government is a perfect hedge for this, and that's the bonds you want to do because you're trying to equate standard of living, I believe. So you trade standard living as, say, measured by aggregate, not GDP, that's different. It's just like for inflation. You don't care about GDP inflation. You care about inflation for your consumption goods if you're a consumer and you're not working anymore. Okay? That I will quit on. But I think I got everything out there. If you didn't get it, the first time I hear a song I like, if I don't like the song, what do I care? The first time I hear a song I like, she's singing, she's going, I don't know one word she's saying. But I like the song. So what do? I listen to it 20 times, 30 times. Guess what? At the end of the 30th time, I know every word. So if you didn't get all the lyrics tonight after dinner on the wine, after a long day, I hope you at least got the melody. Finance science, finance innovation, go back and look at things that we take for granted. it's not thinking out of the box. It's actually using the foundational principles. There's nothing here that is radical, different, but it's enormously different from the way things are done. And you can have big, big impacts, order of magnitude impacts on events, not adding an extra factor, which is nothing wrong with that. You get paid for a lot for it, and that helps efficiency. I'm talking about very big issues like the ones I hope you can see are being addressed here.